Does a 4% plus yield and a double-digit dividend growth rate sound great to you? Want to invest in a business model that makes money from money? Looking for a dividend growth stock that looks undervalued after a 25% drop in price? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is a large US bank. What do you think of when you think about a bank? You think about money, right? My point exactly. Banks make money from money itself. They've been doing that for centuries already, and I imagine they'll continue to do so for centuries to come. And that's part of what sets this bank up for more revenue, profit, and dividend growth. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Truist Financial Corp, which appear to be trading at a significant discount today. Truist Financial Corp, stock ticker TSC, is an American bank holding company. Founded in 1872, Truist is now a $64 billion by market cap financial monster that employs more than 50,000 people. Operating as the 7th largest U.S. commercial bank by deposits, Truist has approximately 2,500 branches that are primarily located in the southeastern portion of the United States. The bank reports results across the following 4 segments: consumer banking and wealth, 54% of fiscal year 2021 revenue, corporate and commercial banking, 35%, insurance holdings, 12%, and other treasury and corporate, negative 2%. The 2019 merger of equals between BB&T Corporation and SunTrust Banks, Inc. formed what is now known as Truist. Florida is the bank's largest market by deposit base, 22%. The banking business model has long been and continues to be one of my favorite business models. After all, banks are literally in the business of money. If you want to make a lot of money, money itself, pretty good place for that. But that's not all. It gets better. Banks make money from other people's money. That occurs by way of the float, which is the business model's powerful secret sauce. A bank is given access to large sums of low cost and low risk capital via deposits. This deposit base, the float, provides a bank the ability to fund loans and other ventures that generate attractive returns. And since the deposit base tends to be sticky, it's usually a reliable source of funds. Banks date back to ancient history. We're talking thousands of years. The everlasting nature of the business model largely comes down to the fact that our society is dependent on the proper flow and utilization of capital. Without this, our modern day economies fail. And without our modern day economies, modern day society fails. That's part of why I have little doubt that this bank will continue to flourish for many years to come. As a result, Truist should continue to grow its revenue, profit, and dividend. Already, the bank has increased its dividend for 12 consecutive years. The 10-year dividend growth rate of 10.2% is strong. Plus, the stock yields a market-smashing 4.3%. It's not often that you find a 4% plus yield paired with a 10% plus dividend growth rate. That's an extremely appealing combination. This yield, by the way, is 90 basis points higher than its own 5-year average. And the payout ratio of 47%, this appears to be a healthy, well-covered dividend. I love these dividend metrics. Looking at business growth, Truist moved its revenue from $10.3 billion in fiscal year 2013 to $25.4 billion in fiscal year 2022. That's a compound annual growth rate of 10.6%. On the face of it, that's outstanding top-line growth for a fairly large bank, especially during an extremely challenging period for banks. But much of this was not organic in nature. The aforementioned 2019 merger of equals created a much larger absolute revenue base, which skews things. Looking at profit growth on a relative per-share basis will give us a better idea of the bank's true growth profile. Truist grew its earnings per share from $2.19 to $4.43 over this period, which is a compound annual growth rate of 8.1%. I see that latter number as a more accurate representation of what the business is capable of doing. Considering how challenging the last decade was for banks, that's a pretty impressive result. Looking forward, CFRA believes that Truist will compound its earnings per share at an annual rate of 3% over the next 3 years. On one hand, CFRA notes elevated net interest margin and continued growth in loan balances as being beneficial for Truist. On the other hand, CFRA points to a difficult operating environment evidenced by credit deterioration and a reduction in mortgage demand. Regarding credit, CFRA states the following, and I quote, "Credit quality deteriorated in the quarter with net charge-offs, NCOs, jumping 7 basis points quarter over quarter to 0.34%. Additionally, provisions for credit losses doubled to $467 million as management noted a decline in its economic forecast," unquote. The last few years have been bumpy and unpredictable to say the least, and since the merger closed just before the pandemic hit, it's difficult to get a feel for just how successful it's going to be. But I'd argue that CFRA is underestimating the bank's potential, particularly as it relates to the geographic footprint. Truist is heavily exposed to Florida, which is one of the fastest growing states in the U.S. That bodes well for Truist. Furthermore, the U.S. interest rate framework is more favorable than it's been in a long time. In addition, the bank has a differentiating factor in its insurance brokerage business, which could offer a smoother path toward growth. The next year or two could be tough, but I think Truist is positioned well for the next decade and beyond. If Truist can deliver just mid-single-digit bottom-line growth for the next year or two, the moderate payout ratio gives the bank the ability to grow the dividend at a similar rate. From there, we could be looking at a nice acceleration back into the high single-digit range. When you're starting off with a 4% plus yield, it's really tough to find fault with that kind of setup. Moving over to the balance sheet, the bank appears to have a rock-solid financial position. Total assets of $555 billion lines up against $487 billion in total liabilities. The bank's senior unsecured debt has the following investment-grade credit ratings: A- Standard & Poor's, A3 Moody's, A Fitch. Profitability is robust, although it's difficult to read too much into this because of the newness of the combined enterprise. Over the last 5 years, the firm has averaged annual net margin of 23.7% and annual return on equity of 9.3%. Net interest margin came in at 3% last year. In my view, Truist is a well-run bank that has geographic favorability. And with large economies of scale, switching costs, unique financial expertise, and built-up relationships, the bank is protected by durable competitive advantages. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. All three of these risks are arguably elevated for a bank like this. Banks are highly exposed to economic cycles. A recession can hurt the bank's income statement through reduced loan demand and balance sheet via higher loan losses. Truist has gained absolute size through the merger of equals, and size can be an advantage, but this bigger size also limits the relative growth that can be produced. This merger of equals, which was poorly timed in some ways, also means that Truist has unique integration risk. Ongoing changes in financial technology may make it easier for upstarts to take market share. I see most of these risks as pretty standard for a bank, but I also see these risks as being more than priced in at this point, as the stock's 25% drop from its 52-week high has created an appealing valuation. The stock is trading hands for a price-to-earnings ratio of 11. That's quite low by any measure, even for a bank. It's nearly half of where the broader market's at. While we have to take recent averages with a grain of salt in this case, consider the stock's 5-year average PE ratio of 13.6. Most banks command price-to-book ratios of between 1 and 1.5. The stock's price-to-book ratio of 1.2, which is in line with its own 5-year average, is on the lower end of that spectrum. And the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 7%. This dividend growth rate is slightly on the conservative side compared to where I normally land for banks. I'm erring on the side of caution here due to the fact that Truist has very little operating history in its current form. If we look at the legacy long-term EPS and dividend growth, this is an easily attainable target for the bank to hit over the coming years. While the next year or two could be closer to what CFRA is expecting, I think the bank's geographic footprint, differentiation, and overall platform positions the institution very well for the long run. The dividend discount model analysis gives me a fair value of $55.64. The reason I use the dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates TFC as a 4-star stock with a fair value estimate of $57. CFRA rates TFC as a 3-star hold with a total market target price of $46. I came out closer to where Morningstar landed on this one. Averaging the three numbers out gives us a final valuation of $52.88, which would indicate the stock is possibly 8% undervalued. Here's the bottom line, guys. Truist Financial Corp is a differentiated bank with a favorable geographic footprint. It produced impressive growth during a challenging period for banks, but rising rates and its recently completed merger of equals sets up the bank for even better performance over the next decade. With a market-smashing yield, a double-digit long-term dividend growth rate, a moderate payout ratio, more than 10 consecutive years of dividend increases, and the potential that shares are 8% undervalued, this idea offers something to like for just about any dividend growth investor. And now for a special news announcement. Albemarle Corporation, stock ticker ALB, just printed a blockbuster Q4 report for fiscal year 2022. Net sales increased by 193% year over year. Adjusted earnings per share grew by 753% year over year. Due to an increase in both volume and lithium prices, Albemarle is practically printing money right now. I've mentioned this dividend aristocrat numerous times on the channel before, and I continue to mention it. The business is knocking it out of the park.
Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you can benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.